The S&P 500 just crossed 7,000. The Nasdaq is on an 11-session winning streak. To the average investor, this looks like the greatest bull market in history. But behind the scenes, a very different story is being written. A few elite contrarians have just placed four of the biggest trades of the decade, and they aren't buying the hype. If you're in index funds or tech stocks, you need to see this. Because if this thesis is right, the next 12 months will be brutal for the crowd, but life-changing for those who see the supply-side gluttony coming. Let's talk about trade number one, the short. While everyone is chasing AI, a high-conviction bet has been placed against the semiconductor giants, specifically looking at January 2027 puts. The reason? A depreciation problem that no one is talking about. Big tech companies are spreading the cost of their AI chips over 6 years on their balance sheets to keep reported profits high. But the manufacturers are releasing new chips every single year. This makes the old chips obsolete in 24 months, not 72. It's an accounting mismatch that mirrors the 2002 WorldCom scandal. When the supply-side gluttony hits and the wait lists evaporate, the air comes out of the room. Trade number two zigs where the world zags, deep value in China. Since 2021, Chinese tech has been beaten down by a geopolitical war premium. But here is the math. The Hang Seng Tech Index is the only index in modern history to have a 1929-style crash while company earnings kept growing. Host, Alibaba and JD.com are trading at utility-like multiples despite having billions in cash. The risk of delisting has neutralized, and the mutually assured financial destruction of the VIE structure means the floor is likely in. This is a mean reversion play on the most compressed valuations in a century. Trade number three is the most misunderstood, the cash-rich acquisition vehicle. People still think of GameStop as a meme, but look at the balance sheet, $9 billion in cash and a growing Bitcoin reserve. Host, in a normal market, it's a boring holding company, but in a market dislocation, the kind of 7,000 S&P level suggests, cash is an offensive weapon. With a founder-operator who only gets paid if the market cap hits $100 billion, the incentive is to buy distressed assets when the bubble pops. It's a crash hedge that pays you to wait. Finally, trade number four, the sins of the past play. Every now and then, a global utility like Fiserv gets annihilated, 44% in a single day, because of poor guidance and old management. Host, but the fundamentals of processing billions in daily transactions don't change overnight. With new leadership resetting the clock and moving back to the Nasdaq, the bad news is fully priced in. It's a disposable razor business trading at a discount because of a temporary shadow, shorting the euphoria, buying the distress, and holding the cash weapons. That is how you survive 2026. The crowd is chasing the breakout at 7,000. The smart money is positioning for the after. Which side of the trade are you on?